Car insurance based on credit score. Influencing, improvement and important notes in most states. Your credit history is one of the personal characteristics used to set your car insurance coverage. According to rate information from Quadrant Information Services for 2022, the average cost of full insurance is $3,002 for drivers with a bad credit history. Drivers with good credit pay an average annual cost of full insurance of $1,556, a staggering 93% less than that. You can learn more about car insurance based on credit score, as well as steps you can take to increase your credit score and possibly lower your insurance premiums. Car insurance based on credit score. Almost all states utilize credit history as a rating factor for auto insurance. According to the Insurance Information Institute, actuarial studies demonstrate that a person's financial management is a good predictor of filing an insurance claim. Hence, drivers with lower credit ratings are statistically more likely to do so. III. Car insurance firms charge higher premiums for drivers with poorer credit scores because there is a higher danger of having to pay a claim. 5 criteria for car insurance based on credit score, all related to your loan history and current circumstances, are used to determine your credit score, also known as the FICO score. Payment platform. 35% payment due, 30% credit history, 15% mixed types of credit, 10% new credit, 10%. The credit score range is 300 to 850. They usually have multiple grades. However, car insurance based on credit score is not as simple as a specific score matching a particular rate. To determine your insurance score, insurance companies use your entire credit report and feed it into an algorithm. States may vary in how much car insurance is affected based on credit score. California, Hawaii, Massachusetts, Michigan, and Washington are the only 5 states that prohibit the use of any credit report to influence premiums. Instead, these states decide on pricing based on factors including location, driving history, and others. Drivers can also be penalized for not having a credit history, which is sometimes considered a bad credit history by insurance companies. Drivers with no credit history may be better off with a bad credit history because insurance companies are not allowed to penalize motorists in some jurisdictions, such as New Jersey and Rhode Island. Why is car insurance based on credit score? While your credit history often affects the price of your car insurance, businesses don't consider your raw credit score. Car insurance based on credit score is used by insurance companies to check a consumer's credit history and estimate how likely they are to experience insurance losses. Underwriters are more concerned with how efficiently you handle your money than with how much money you make. While each insurance company has its own unique underwriting methodology for determining coverage-based credit scores, the following general factors are generally taken into account. Current debt. This section shows how much you owe now. Duration of credit history. This shows how long you have had an active line of credit. Combination of credits. This reflects different lines of credit, including credit cards and car loans. Payment platform. This shows how successfully you have paid your obligations over time. Seeking new credit. This indicates recent attempts to add a new line of credit. These factors work together to assist insurers in determining the risk profile of their insureds. According to studies, there is a link between the number of claims made and credit-based insurance scores. Statistically, the more likely you are to submit an insurance claim, the lower your coverage score will be. Insurance companies often charge higher fees if you have a low credit score because of this higher risk. Do insurance companies check your credit? To get auto insurance, your credit will be checked in almost every case. Every major auto insurer uses driver's credit history in some capacity, according to a report from the Federal Trade Commission. In a few places, including California, Hawaii, Massachusetts, Washington, and Michigan, insurance firms are not allowed to utilize credit scores to set auto insurance premiums. The reason insurers check your credit is that studies have shown that credit rating tends to be a good indicator of how many claims a driver will file. That allows insurers to match more expensive rates with drivers who will likely use their insurance more. Car insurance based on credit score. How to improve your credit score. Your overall financial health, especially your car insurance based on credit score, is very important. You may be eligible for lower interest rates, a larger line of credit, or loan approval with a good credit score. There are strategies to increase your credit score if it's not the best. While it may take some time, increasing your insurance score and decreasing your credit score can lead to lower auto insurance rates. Pay your bills instantly. Your payment history is one factor used to calculate credit-based insurance scores. Companies may assume you have poor money management skills if you have a history of unpaid bills and past due credit card debt. As a result, you may not have enough money on hand to cover small losses. You can then file an additional claim accordingly. Your insurance score and overall credit score can go up if you consistently pay your bills on time. Reduce the number of hard credit queries. There are two types of car insurance based on credit score claims: hard checks and soft checks. Every time you apply for a line of credit, the business that considers you a customer will retrieve your credit report, which is a difficult requirement and has an impact on your score. It's a soft investigation, so your credit rating during the insurance company's quote process won't affect your actual credit score. A large number of difficult questions can reduce your score. You may want to think twice before applying for a loan or line of credit if you're trying to improve your credit. Check your score often. Tracking your car insurance based on your credit score has several advantages. Knowing your score makes it easy to take action to increase your score. You can find errors or fraudulent activity by regularly reviewing your credit reports. You can take action to protest anything strange you see. Know your credit utilization rate. Your credit score is determined by a number of factors, and one of them is credit usage. The amount of credit you have available versus the amount you use is measured by your credit utilization ratio. While there are no hard and fast rules for how much credit you should use, many financial experts recommend that you use no more than 30% of your total credit at any one time. Paying off some debt to lower your credit score will help you increase your credit score if you are using more than 30% of your available credit.